The scale of economic change that investors face is massive, but also the confidence interval around that change is wide. If you think about what we were experiencing in the second quarter, estimates for GDP growth, the topmost economic indicator, ranged from negative 12% to negative 40% and landed at about negative 32% for Q2. And that's the worst quarter on record. In the face of change that powerful, traditional gauges of economic activity has failed us. And that's a challenge for investors, but it's also an interesting opportunity to take a step back and think about the powerful cross currents we face and how those might be what shapes the economic environment. So as long as this virus is with us, I'm looking at really only two factors facing the economy: the path of the virus itself and the policy response to the virus. It sounds simple, but these are the factors that will dictate the economic and investment environment, again, as long as the virus is with us. There are certain elements of prior recessions that apply to this environment. Discipline in your portfolio investment process, a focus on real value creation throughout the economic cycle so that your portfolio is prepared when a crisis hits, that type of thing. But the quirks of the COVID crisis make it really difficult to draw exact or distinct parallels. We've seen an economic rebound so far, but the path and the pace of the recovery from here is so much less certain. And so as long as the virus is with us, the COVID crisis is going to create pronounced winners and losers across the economy and investments as well. Economic and market data have reflected this bifurcation to date. So if you think about highest earners in the economy and those who can work from home, the recession is already over. Policy support and an early economic rebound and investor sentiment mean that valuations can continue to move higher in areas that have supported this work from home environment. But on the other hand, a large economic gap, long-term unemployment rising, and COVID vulnerable business models point to a steady credit default cycle in the coming months. The particularities of COVID-19 have created pronounced winners and losers in the investment environment. I like to think about it as a K-shaped portfolio or a K-shaped investment environment for different sectors. So instead of thinking about maybe one different industry or different sector, I'm thinking in terms of COVID resilient business models, skilled managers who focus on value add, or those companies who have been able to raise capital to help bridge the gap that's been created by the COVID economic environment. These are the companies that are doing well or doing better. Meanwhile, COVID vulnerable business models, poorly capitalized companies who have high costs of credit and have struggled to bridge that COVID created gap, or companies that rely on consumer mobility, those have been the business models that are struggling. And as long as the virus is with us, these trends are going to persist. And again, if we think about what that really means, the virus itself maybe is resolved by medical treatment, but it could still take 6 to 12 months before mobility improves from that point. And so investors really should be thinking about this K-shaped bifurcation and what it means for their portfolio as a whole. The last time that I was able to join a super return conference, which was in Los Angeles in February, LPs were already concerned about high valuations and unreasonable return expectations. At that point, the economy was doing well, but again, valuations were high and we were concerned about company profitability across the board. Since then, the economic environment has certainly changed. Economic activity is rebounding from a very low base, but is likely to stay below pre-COVID levels for maybe the next 2 or 3 years. But that doesn't mean that all investment strategies are at peril, far from it. Low interest rates persist, and some companies and strategies are actually benefiting from the way that COVID has accelerated some pre-existing trends in the economy, things like digitization, e-commerce, and mobility. That said, the environment's still tricky, and so investors need to focus on real value creation and good management teams that have experience navigating these difficult economic environments and difficult return expectations. This crisis has been difficult and will continue to create a drag on the economic environment. But the sheer size and scale of the crisis and the way that it's so different from any recession in recent history gives investors the opportunity to step back and consider, what might the future state of my investment portfolio look like? In business and technology, we speak about the S-curve, which is the concept that people and processes adapt really slowly until there's a trigger, something that is a force for change that pushes things to change more quickly before stabilizing over time. And that the companies that are able to leverage those changes are those that are going to see increases in performance. So now in the economy, the forces that shape our future, things like the global tensions, the economic policies, the political ideas, those are being magnified by the COVID economic environment. And I believe that investors should capture two types of changes. One is that acceleration of pre-existing trends, like I mentioned, things like digitization or e-commerce. And another is thinking about the totally new ideation of new trends. Investors that are able to capture that change, capture the S-curve, are the ones that are most likely to succeed in the new future state of investing.